Have you ever felt betrayed by so-called experts who are supposed to guide your financial decisions but end up leading you astray? Welcome to Incompetent Capital, where accountability for competence on Wall Street is our #1 priority. Today, we put the spotlight on 5 analysts who've utterly failed you and countless other investors. Their glaring mistakes and misguided predictions will leave you questioning their credibility and, more importantly, your own investment strategies. Why did these experts miss the boat on DR stock? What are the consequences of their blunders? Prepare for a detailed exposé that reveals their catastrophic errors in our famous Incompetence Court. We'll dive deep into their flawed analysis and the ripple effects it had on investors. But the real intrigue, we're not just pointing fingers. We'll uncover what went wrong, why their judgments were so off-mark, and how it affects your portfolio. But wait, there's more. Today, we're not only exposing the failures, but also celebrating a true beacon of competence. Meet our Competence Award winner, who warned investors about a bull run that was fundamentally bankrupt. This hero not only saw through the smoke and mirrors, but also provided invaluable insights before the bubble burst. Stick around as we unravel the truth behind DLTR's stock performance and highlight the lessons from those who got it right. It's time to arm yourself with the knowledge that these analysts failed to deliver. Don't miss out. Your financial future just might depend on it. Be sure to like, subscribe, and hit the notifications icon so you can be notified accordingly. And stay tuned until the end for a deep dive on Dollar Tree. In the investing world, it's rare that we see competent stock analysts, and we love to give credit where credit is due in this regard. Robert Omes of Bank of America Merrill Lynch is a shining star in this regard. He warned investors before the bull run that ended in disaster and ruin for many. I'm not going to lie, he did play a little bit of chase with the stock price, which we don't particularly like, but in this case, he gets a pass in my book because he made the bold move to call sell on the stock when it was about to blow up. He saw the fundamental writing on the wall, and he stuck with his guns, even though many people probably criticized him for it in the moment, and he did the right thing. Good job, Robert. That isn't easy to do. Our next analysts, unfortunately, will get a little bit of a different tone than Robert. They are going to have to answer for some pretty incompetent moves and will be held fully liable in our Incompetence Court. Kelly Banier of BMO destroyed the incompetence meter on Dollar Tree. As you can see, Kelly started pretty conservative on this stock, giving a series of market calls that were more or less in line. Okay, you want to see what's going on when you first get assigned to the stock. We get it. But unfortunately for her, right before the stock was about to hit its peak, she decided to go all in. She then stayed super bullish until August 2024, when she began to go neutral again. So she goes neutral before the stock begins its bull run, only to switch to super bull mode, both overbidding and erroneously touting the stock as a buy, and then waiting for the stock to hit the trenches to tell investors that she doesn't know what's going on. Again, Kelly props for going all in, but you gotta do more homework next time. Try showing up to work and partying less. It will definitely improve your numbers, and you will bankrupt less people next time. Where do they find these people? Oh, they find them at top-tier universities. I forgot. Are you looking for a way to make money that doesn't involve going into $500,000 in unmanageable debt? Then consider starting your own YouTube channel. With Tube Magic by Matt Parr, you'll learn everything you need to start, optimize, and grow your channel into a profitable venture. Matt's course draws on years of experience in running successful niche channels and teaching countless students to achieve financial freedom. Click the link in the description to get started with Tube Magic today. The next culprit of the day, Scott Sickery of Truist, is guilty as charged of gross incompetence and copying Kelly. As you can see on the chart, Scott's incompetence closely resembles that of Kelly, except for one difference. Scott was extremely bullish from the start, picking Dollar Tree as a top pick. Okay, it was the beginning of the bull run, except for the fact that Rob maintained a bullish position all throughout the crash as well. In fact, to this day, he still touts this stock as a buy in the trenches. Another thing to note is that Scott tamed his inner bull by being aggressively conservative, if that's even a term, with his actual price targets. Notice how he played chase with the stock price, even from the get-go. Usually, analysts who play as cheerleaders overbid a little or a lot. Scott was merely copying Kelly's homework and playing it safe so he could go on misleading investors. Busted, convicted, and sentenced to life of manual number crunching for the racist, evil, sanctimonious warden in the Shawshank Redemption. Next, Your Honor, we call Joseph Feldman of Telsey Advisory to the bench. Joseph is being charged with prematurely throwing a money party to celebrate his wins and then leaving the money party intoxicated to stir a ship of investors into the trenches. As you can see, Joseph was conservative with his price estimates and relatively conservative with his market perform before the peak, and he was actually half right. So he threw his infamous money party and then went all in with an overshot bid of 175 when the stock was around 148, and finally an all-buy call. But unfortunately for him, the stock began its decline later that year, and Joseph continued to cling for dear life as the ship sank with his ridiculous buy calls, which he holds to this day. Joseph, at least play chase on the way down, like the others did, so you can hold your head up. So when the stock was on its rise, he played conservative and played chase with the price, and then when the stock was on its downfall, he overbid and touted the stock like a high school cheerleader. Guilty as charged. Disclaimer: Incompetent capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. Our next culprit, Michael Lasser of UBS, is a permabull on this stock. As you can see, he made buy call after buy call to this day. And actually, Michael was right in his bullishness before the peak and called an almost spot-on overbid in January 2019 that eventuated before the stock peaked. He then called the peak almost spot-on in November 2021. For that, he gets credit, especially as that 2019 call was bold. It's literally the only thing you see on the chart when you look at it. But unfortunately for him, after that, the stock took a turn for the worse, and he never changed his bid. And those bullish calls at that point ended up screwing over many people. Definitely incompetent on the back end of this play, but he did also make people some money on the front end of this play. So we sentenced him to analyst probation. Comment on whether you agree with this sentence or not. Had he simply changed course and lowered right before the crash, he would definitely be getting a competence award. All of the analysts on trial today had a similar sentiment after the crash. It's almost as if they call each other when there's blood on the street to agree on a common position. But could they have avoided this? Were there clear signs of problems brewing in Dollar Tree that they missed or even outright ignored? Dollar Tree, founded in 1986, has grown to become a leading player in the discount retail space, offering a wide range of merchandise, including everyday essentials, seasonal goods, and household items, all at low prices. With its headquarters in Chesapeake, Virginia, Dollar Tree operates thousands of stores across the United States and Canada under both the Dollar Tree and Family Dollar brands. The company has built its success by appealing to budget-conscious consumers, offering value-driven products in accessible locations. In recent years, Dollar Tree expanded its offerings by introducing items priced above the traditional $1 mark, responding to inflationary pressures and changing consumer habits. However, despite its strong market presence, Dollar Tree has faced increasing challenges. This brings us to the latest developments, where the company's stock took a significant hit and is continuing to get pounded. Dollar Tree experienced a plummet from its all-time high of 177.19 and currently sits at a paltry 66.50. At one point, Dollar Tree experienced a sharp decline in its stock, marking its worst single-day drop in over 2 decades due to weaker-than-expected financial results and economic pressures affecting its customer base. The retailer's second quarter earnings in 2024 missed projections by a significant margin, causing its stock to tumble by a whopping 19.6%. While there was a slight increase in foot traffic at both Dollar Tree and Family Dollar locations, customer spending per visit decreased, particularly among wealthier shoppers who have been impacted more by inflation and rising interest rates. This trend contrasts with Dollar General, which saw its earnings hit by a reduction in spending from its lower-income shoppers. Dollar Tree's same-store sales increased by a modest 0.7%, falling short of the anticipated 1.5% growth. Although there was a slight increase in traffic, the average purchase amount per customer dropped. Part of the company's earnings shortfall was due to an adjustment in its general liability accrual, but the lackluster sales growth also played a key role in the financial miss. Looking forward, Dollar Tree lowered its full-year forecast for earnings and sales, now predicting only low single-digit same-store sales growth, down from earlier, more optimistic estimates. Additionally, the company is facing higher costs related to managing customer accident claims, which have become more unpredictable due to rising litigation and settlement expenses. Dollar Tree is also reviewing its Family Dollar business for potential sale or restructuring, and is continuing to close underperforming stores to improve its overall portfolio. So far this year, Dollar Tree's stock has fallen by 53.8%, reflecting growing concern about its ability to adapt to these challenges. In an economy plagued with inflation, it is always important to be cautious as an investor. These analysts often provide optimistic forecasts based on short-term trends, but unexpected market shifts, like the impact on Dollar Tree's earnings, can quickly change the outlook. While some companies appear stable due to strong consumer demand, external factors such as rising interest rates and inflation can create unforeseen challenges, especially for businesses reliant on consumer spending. Investors should be mindful of these broader economic pressures and not solely rely on historical performance or analyst predictions when making decisions. It is crucial to assess a company's adaptability to market conditions and long-term growth strategies, as temporary setbacks like those seen at Dollar Tree can signal deeper issues within a company's ability to navigate an unpredictable economic landscape. Diversifying investments and continuously monitoring market conditions are key to making informed decisions in today's volatile financial environment. So today's lesson is short and sweet. Do not ignore the overall macroeconomy. If you are investing in a company that relies on a low-cost market model, then you may be looking for trouble. So going forward, listen to macroeconomy ESP in industries where they are affected by the rising costs that we have all been getting pounded by, and any other macroeconomic indicators that may affect other industries should also be taken into account. If, for example, you are investing in a tech company affected by supply chain disruptions or fluctuating energy prices, you should factor that into your analysis and proceed with caution when these indicators start flashing red. Ignoring these warning signs could leave your investments vulnerable to sudden market shifts. Always stay vigilant and proactive, for if you don't, you just may wake up one day, turn on YouTube, and see yourself on trial in Incompetence Court. Check out this video for a deep dive on Boeing Aerospace, what went wrong, and how you can better position yourself to be a successful investor.